Richard Ivers from Prime Value Asset Management. Welcome to the Growth Symposium.
Thanks for having me.
Why small companies and why now?
Small companies are interesting right now because they've fallen so far already. So over the last 15 months or so, small caps have fallen about 20% or thereabouts, whereas large caps have only fallen about 6%. So, and when markets rebound, small caps typically rebound the most. They fall the most in the downturns, but they rebound the most in the upturns. So there's already a lot of bad news priced into small caps. And when markets do finally turn, there's probably a lot more upside in them as well.
And I know your name has value, but you're not a traditional value investor. Could you talk us through how you find opportunities in smaller companies?
That's right. We're a GARP investor, or style neutral, but GARP bias. Prime Value started from operates across multiple different asset classes, and those asset classes we try to find value in what we buy. So we never buy Bitcoin, for example. But how we look for opportunities is we have an extensive company meeting program between the three of us in the small cap team. We meet about 4 companies on average. The way we assess whether to buy a company or not is we look at the potential returns per annum, and we want a minimum return of 10% per annum. We strip out a lot of low quality, high risk businesses like resources and loss-making businesses. So we tend to have a higher quality focus and bias, and we tend to generate very strong returns with relatively low risk because of that.
And you have quite a unique benchmark compared to a lot of your competitors. Could you walk us through that?
Yeah, so we have an absolute benchmark of 8% per annum. That is determined by the fact that over the long term, small caps have generated a return of around 8% per annum, so it's a reasonable benchmark. And we have an absolute benchmark because we're very focused on capital preservation and protecting downside. So we don't collect performance fees when we outperform in down markets, so we might fall less than the market. We don't charge a performance fee for that. So we have the benchmark, we're trying to deliver an absolute return. As it stands currently right now, our high watermark means that we have to generate a return of around about 20% to get back to that high watermark. Even though we've outperformed over the last 15 months, the high watermark means that we have to recoup all the losses for new and existing investors before we charge performance fee again. So now is a really good time for a performance fee perspective.
And what's one of the most important fundamental or investment metrics when looking at the smaller company sector?
For us, it's the potential return per annum. So another way of putting that in a technical term is the internal rate of return. So what's the potential annual return you expect to get from that investment? And we want a minimum return of 10% per annum. Now that factors into a lot of different things. So, it factors into the potential earnings growth, the dividend yield, the multiple that the business is trading on, and the prospective multiple that it's trading on. But if you boil all that down and bring that into one thing, it's prospective return or internal rate of return over the next 3 to 5 years.
And where's the biggest part of your risk management process? Is that on sector allocations, stock weightings, or more broadly?
Yeah, we have a number of different risk factors, but if you boil it down, the most key factor behind delivering a lower level of volatility for the fund and a lower risk is that we tend to invest in higher quality businesses, and we importantly structure the portfolio such that we have big weightings in more certain returns and we have small weightings in potentially very high returns but often come with higher risk. So that portfolio construction perspective is very important to delivering the very low level of standard deviation or risk in the portfolio.
And what's one of the most compelling ideas in the portfolio at the moment?
One I like at the moment is EQT, or Equity Trustees, which just acquired a business last year, and we think the market is underestimating the returns that are going to be generated from that business and the synergies that will come out of it. There's been some operating leverage that's expected to come through as they've created efficiencies and more automation of their operations. And the stock is trading on a multiple well below its historical average as well. And you've also got structural tailwinds coming through in terms of the independence of trustee role that came out of the Royal Commission a couple of years ago. So you've got, put all that together, you've got a few things in their favour, or tailwinds. You've got synergies from the acquisition, the accretion from the acquisition, the structural tailwinds in terms of independent trustee roles, they're becoming more and more important, and then the low multiple, which makes it really attractive as well.
Richard Ivers, thank you.
Thank you.